Today, we're making the investor's case for Bitcoin. Not the hype, not the tech. The case that a serious investor, someone who already allocates across stocks, property, and gold, should be thinking about right now. Welcome back to Bitcoin, Crypto, Gold, where we focus on the biggest wealth opportunities across Bitcoin, crypto, and gold using macro, technicals, and strategy. If you want that in a simple daily format, the free newsletter is linked below. It's a quick 5-minute read. Let's get into it. Most investors who haven't bought Bitcoin yet aren't ignoring it because they think it's worthless. They're on the fence because no one has explained it properly, in the language of investing. So that's what this video is. By the end, you'll understand not just why Bitcoin exists, but why the current global environment is actually pushing investors toward it. Let's start with the most important idea of all. Every major government in the world is spending more than it earns. The US alone has over $39 trillion in debt, and it's not alone. This is happening globally. So how do governments deal with that level of debt? They inflate it away. That means printing more money, increasing the supply of currency, and slowly reducing its value over time. This is what's called currency debasement. And it doesn't feel like a crash. There's no alarm, no dramatic moment where you notice it happening. But year after year, your money buys less. The Federal Reserve officially targets 2% inflation annually. That means they are explicitly planning for the dollar to lose purchasing power every single year. At 2% per year, $100,000 today is worth approximately $82,000 in real terms after 10 years. After 20 years, $67,000. This is not a theory. It is the stated policy of every major central bank on Earth. Now compare that to Bitcoin. Bitcoin has a fixed supply, 21 million coins. No more will ever exist. No government can change it. No central bank can print more. So you have a very simple contrast sitting in front of you as an investor. On one side, an unlimited money supply being deliberately expanded by governments carrying record levels of debt. On the other, a fixed supply that no authority on Earth can alter. That contrast is the foundation of the investment case. Now let's talk about bonds, specifically U.S. Treasuries. For decades, they were considered the safest investment in the world because they are backed by the full faith and credit of the U.S. government to ensure the return of principal and predictable interest income. But that's starting to change. The U.S. government now pays over $1 trillion per year just in interest on its debt. So the central bank faces a problem. If they keep interest rates high, the debt becomes unmanageable. If they lower rates, inflation increases. One solution that's already being used in places like Japan is called yield curve control. This means keeping interest rates artificially low, even below inflation. So now think about that as an investor. And what that creates for every investor holding government bonds is a guaranteed negative real return. You earn interest on paper, but your purchasing power is going down faster. Think about what that means. The world's largest, most liquid, most trusted bond market is being managed to produce a loss in real terms. If traditional, safe assets are losing value in real terms, where does the capital go? It starts looking for alternatives. That's why we're seeing strong flows into gold and increasingly into Bitcoin. Now let's talk about gold as an investment. Gold has been one of the best performing assets of recent years. The long-term case for gold remains strong, and we cover it in detail across our macro and investing playlists. But gold has practical limitations for investors at scale. It's expensive to store, expensive to insure, difficult to move in large quantities, and at current prices, meaningful allocation requires significant logistical and financial commitment. There's also a deeper thesis developing among macro analysts that gold held on central bank balance sheets, currently valued at historical acquisition prices, may be officially repriced as part of a broader monetary reset. If that happens, gold becomes a strategic sovereign reserve asset at a new baseline, potentially making it less accessible as a practical investment vehicle for individuals at scale. Bitcoin addresses what gold cannot. And before you assume Bitcoin is out of reach, it isn't. Bitcoin is divisible to 8 decimal places. The smallest unit is called a Satoshi, named after Bitcoin's creator. 1 Bitcoin equals 100 million Satoshis. So you can buy $100, $500, $1,000. You simply own that fraction of one coin. You don't need to buy a whole Bitcoin any more than you need to buy a whole share of Amazon. You buy what makes sense for your allocation. There's no storage requirement, no logistics, no physical security. This is not an argument against gold. Gold belongs in the portfolio. We hold gold alongside Bitcoin, and we explain exactly how those two assets work together in Part 3. It's an argument for Bitcoin as the complement. Where gold is the physical anchor of monetary sovereignty, Bitcoin is the digital equivalent with properties gold cannot match at scale. The investor who understands both is better positioned than the investor who holds only one. Beyond the macro thesis, there's a straightforward performance case that most investment content never presents honestly to this audience. Over every meaningful long-term time horizon, Bitcoin has outperformed virtually every other asset class. It has outperformed the S&P 500. It has outperformed gold. It has outperformed the portfolios of the majority of professional fund managers. This is not a prediction, it is a historical observation. And here's the key point for the investor thinking about allocation. You don't need a large position to benefit. Think about the asymmetry. If Bitcoin drops 50%, and it has done this multiple times in its history, a 5% portfolio allocation loses 2.5% of your total portfolio. Painful, but manageable. If Bitcoin rises several 100%, which it has done also multiple times, that same 5% allocation can meaningfully transform your overall returns. Limited downside at the portfolio level, large upside potential. That asymmetry is what makes Bitcoin interesting to serious investors who would never bet everything on a single speculative position. BlackRock, the largest asset manager in the world with over $10 trillion under management, has publicly stated that a 1 to 2% allocation to Bitcoin is reasonable for a diversified portfolio. That is not hype. That is one of the most sophisticated risk management organizations on Earth making a considered allocation recommendation. Here is the development that most individual investors have not fully processed yet. Institutional adoption of Bitcoin is not coming. It is happening right now. BlackRock's IBIT Bitcoin ETF became one of the fastest ETFs in history to reach $50 billion in assets under management. Fidelity, Invesco, VanEck all offer competing products. Sovereign wealth funds are beginning to allocate. Corporate treasuries hold Bitcoin on their balance sheets. Pension funds are evaluating exposure. At the same time, the regulatory environment is clarifying. The Genius Act and the Clarity Act, currently moving through the U.S. legislative process, are building the legal infrastructure for the full weight of institutional capital to enter this market legitimately. Now zoom out and look at the scale. Global investable assets total over $500 trillion. Bitcoin's current market capitalization is approximately $2 trillion. A 1% reallocation of global institutional capital into Bitcoin would represent a demand shock that dwarfs anything the market has seen. The question for an individual investor is not whether institutional capital is coming. The evidence shows it already is. The question is whether you want to be positioned before it arrives at full scale or after. Let's bring the investor's case together into a simple framework. There are 4 things every serious investor should apply when evaluating any asset. Liquidity. Can you access your money when you need it? Bitcoin trades 24 hours a day, 7 days a week, globally. No market hours, no settlement delays, no geographic restrictions. On this criterion, Bitcoin scores as well as cash, and better than property, gold, or private equity. Security. Is your wealth protected from systemic failure? Bitcoin has no single point of failure. It cannot go bankrupt. It cannot be bailed in by a bank in crisis. It has operated continuously for 15 years without a major failure of the core protocol. On this criterion, Bitcoin outperforms bank deposits, bonds, and any asset held within the traditional financial system. Fixed supply. Can anyone inflate it away? 21 million Bitcoin. Fixed by mathematics, impossible to change. No central bank, no government, no institution can create more. Gold comes closest, but its supply still grows every year as new deposits are mined. Bitcoin's supply is absolute. Sovereignty. Can any government block, freeze, seize, or control it? This is where Bitcoin separates itself from every other asset class. Cash can be frozen. Bank accounts can be seized. Gold has been confiscated. The U.S. government did exactly that in 1933. Property can be compulsorily purchased. Stablecoins can be frozen by the issuing institution. CBDCs, the government-issued digital currencies being developed across multiple countries right now, can be programmed to restrict spending, expire, or be blocked entirely at the government's discretion. Bitcoin cannot. A Bitcoin transaction, properly executed, cannot be stopped by any government or institution on Earth. For an investor thinking about long-term financial sovereignty in a world of increasing capital controls, sanctions, and financial surveillance, that property is without parallel. No other asset scores strongly across all four criteria simultaneously: liquidity, security, fixed supply, sovereignty. That is the investor's case for Bitcoin. So let's bring part one together. Your cash is losing purchasing power every year by design. Bonds are delivering negative real returns as central banks manipulate yield curves to manage debt that cannot otherwise be serviced. Gold is performing well, but carries practical limitations at scale. Bitcoin offers fixed supply, complete liquidity, sovereign-proof ownership, and a track record of outperforming every major asset class over meaningful time horizons. And the largest pools of institutional capital in the world, BlackRock, sovereign wealth funds, corporate treasuries, are already allocating. The question is no longer whether Bitcoin is relevant to a serious investor. The question is how to invest in it properly and how to think about it as part of a broader portfolio strategy. That's exactly what we build in parts 2 and 3. Part 2 gives you the full landscape, what Bitcoin actually is, how the crypto ecosystem works, and the key concepts every investor needs before they commit capital. Part 3 is the practical playbook, portfolio construction, buying strategy, wealth structuring, and the bigger picture that ties it all together. Before you go, join our free newsletter aimed at Bitcoin, crypto, and gold investors. The newsletter covers everything you need to know to make rational, balanced investment decisions in Bitcoin, crypto, and gold. It usually is a 5-minute read. The link is below and in the description. Subscribe to Bitcoin Capital Gold and hit the notification bell so you don't miss part 2. Thank you for watching. We'll see you in the next video.